While every fund manager on Wall Street is scrambling to chase the next rally, one man is sitting on $400 billion in cash and doing nothing. And that's exactly why you should be paying attention. Berkshire Hathaway's cash pile has ballooned to historic levels. Buffett isn't buying. He isn't panicking. He's waiting. And history says that when Warren Buffett waits this long, this patiently, something big is coming. So is this genius, or is the greatest investor of all time finally losing his edge? Let's break it down. Here's the number that's breaking the internet in investing circles. Berkshire Hathaway is holding close to $400 billion in cash and short-term treasury bills. That's not a typo. That's larger than the entire GDP of most countries. For context, Berkshire's cash pile has historically sat between $30 to $150 billion. This isn't a normal, we don't see anything we like situation. This is Buffett pulling back the throttle in a way we've rarely seen in his 60-plus year career. The last times Buffett built up cash to extreme levels? 1999, right before the dot-com crash, and 2007, right before the global financial crisis hit. You see the pattern forming here. So why isn't the so-called smartest investor alive deploying this cash into stocks? 3 reasons. First, valuations. By Buffett's own favorite metric, the ratio of total stock market value to GDP, nicknamed the Buffett Indicator, markets are trading at levels he's previously called playing with fire. Second, quality at a fair price is nearly impossible to find right now. Buffett has always said he'd rather buy a wonderful company at a fair price than a fair company at a wonderful price. Right now, wonderful companies are trading at anything but fair prices. Third, Buffett has openly compared parts of today's market behavior to a casino. Speculative trading, meme stock mentality, options gambling dressed up as investing. He wants no part of it. This is classic Buffett. Not bearish. Not pessimistic. Just disciplined. There's another layer to this story that most retail investors are missing. Greg Abel, Buffett's handpicked successor, is now stepping fully into the CEO role. And a massive cash position doesn't just protect Berkshire from a downturn. It hands Abel maximum flexibility on day one. Think about it from a succession standpoint. Buffett isn't just protecting shareholders. He's setting up the next era of Berkshire with the biggest war chest in company history, so that whoever takes the wheel next has the option to be aggressive when the moment is right, without needing to raise capital or sell positions under pressure. This is Buffett playing chess, not checkers. 3 moves ahead, as always. Now here's where this matters for you, especially if you're investing through SIPs and Nifty or Sensex index funds, or picking individual stocks on the NSE or BSE. Buffett's behavior is not a signal to panic sell everything. It's a signal to get disciplined. Lesson 1, cash is a position too. Holding some dry powder isn't losing to inflation, it's buying optionality for when better prices show up. Lesson 2, don't chase. If valuations feel stretched in the names you're watching, you don't have to buy today just because everyone else is. Lesson 3, keep your SIPs running regardless. Buffett's strategy is about lump sum deployment timing for a company managing hundreds of billions. For most retail investors doing monthly SIPs, rupee cost averaging through volatility is still the proven long-term path. This isn't an instruction to stop your SIP, it's a reminder to stay rational about new lump sum bets. Now let's play devil's advocate for a second, because not everyone agrees this is genius. Critics argue that Buffett has been too cautious for years now, that Berkshire has underperformed the S&P 500 during major bull runs because of exactly this kind of conservatism. Sitting on cash during a multi-year rally means missing out on real gains, and some analysts say Buffett's framework, built in a different economic era, may simply be too conservative for how modern markets, driven by passive flows, retail trading apps, and AI-fueled momentum, actually behave now. That's a fair critique. Buffett himself has admitted he's made mistakes, missed opportunities like early Google and Amazon, and isn't infallible. But here's the counterpoint. Buffett doesn't play for this quarter or even this year. He plays for decades. And almost every time he's been called too cautious, the market has eventually proven him right, just on his own timeline, not the market's. So is Buffett the smartest man in the room right now? Maybe the better question is he even trying to be? Buffett has never claimed to predict crashes. He's said it himself, repeatedly. He has no idea what the market will do tomorrow, next month, or even next year. What he does know is value. And right now, his read on value is telling him to wait. $400 billion in cash isn't a prediction. It's a position. And for Indian retail investors especially, the real lesson isn't sell everything. It's know what you own, know what it's worth, and don't let fear or FOMO make decisions that discipline should be making instead. If you found this breakdown valuable, hit subscribe. Every week we break down Buffett's, Munger's, and Berkshire's moves, and translate them specifically for Indian retail investors navigating Nifty, Sensex, and SIP investing. Drop a comment. Do you think Buffett's $400 billion cash pile is genius patience, or a missed opportunity? Let's discuss below. See you in the next one.